How's it going, everyone? I'm here with Don McDonald, the founder and president of Waverly Financial. We're here at the Multifamily Conference 2024, and we're having a talk right now because you just told a whole bunch of investors that public equities can be a complete waste compared to some alternatives, and we'll get into that. We have a lot of customers who they get a mortgage through us, whether residential, commercial. They're kind of low on funds, but they've got just enough where they want to get going again. And you've got some other alternatives to the stock market. Let's talk a bit about that and maybe start with what Waverly does.
Sure. First of all, thanks for this.
Yeah, of course.
Very, very nice to participate. Yeah, so we are a boutique investment dealer, so a securities dealer.
Yeah.
And we focus on what is known as alternative investments. And we broadly categorize that as not the public markets.
Got it.
So that can be real estate, can be private equity, can be mortgages, can be a number, can be music royalties, can be...
Music royalties. Okay, more on that later. Okay, interesting.
Yeah, so it spans a very broad range. And the reason we're such big fans of alternatives is if you look at the ultra high net worth, the major pension funds, the major endowment funds, and you look at their portfolio, they're going to have less than a 20% allocation to public equities.
Versus your financial advisor might expose you how much to public equities out of your...
Well, it really depends on your age, but
Right.
80% is not unusual.
Okay, so it's inverse based.
And the balance of that is typically bonds, which unfortunately right now are 100% correlated with equities. So a lot of Canadians right now are taking 100% public equity risk.
Right.
And, I'm all about diversification and protecting your downside. So that's something that we try to educate people about is what other options to the public markets.
Got it. And so I go to my financial advisor, they're saying, here's a little mutual fund, a little recipe, and I don't know, 8% return, and looks safe and good and diversified. That's perhaps low-hanging fruit for a much better path. You want to give some examples of these alternatives and maybe just how I think they can be anywhere from 1.5 to 2 times more, depending on what you do. Just give us a quick alternative here, because it seems like everyone's very focused on equities. What else?
So like any investing, there is risk involved.
For sure.
So what we look for is what I call high risk-adjusted returns.
Okay.
Basically what that means is how can our clients make more money and take less risk than other options they may have.
Would be nice.
Not to seem flippant, we don't get out of bed for 8%.
Yeah.
And
especially with inflation and taxes.
Yeah, exactly.
All the
You need to keep up with inflation.
Yeah.
And so it's a fairly broad range. And again, it depends on the risk you're willing to take. So we have very conservative secured investments like mortgage funds,
Right.
which are secured by single family, owner-occupied residents of the GTA.
Right.
Funds that have been around for years have over $1 billion in assets, and they pay 11%.
Wow. So I put in $10,000, and then you're like, thank you very much. This is going to go towards a pool of different single-family homes that we've put a bunch of money in, and it's all backed through real estate, and it's going to make a lot more than some of the equities potentially.
Exactly right.
Got it.
Well, and certainly more than if you're someone looking for some cash flow. Your options, are government and corporate bonds and GICs, and you're not going to get anywhere near to that, and you're going to have to bear a lot more risk.
Got it. So on top of the higher return through this, it's just like an annualized equity growth. There's also a dividend or a kind of cash flowing mechanism for me to put my $10,000 in, have a certain return, but also get a form of dividend. That would be higher than a GIC or a dividend paying stock usually.
So it's not, it doesn't appreciate over time.
Yep.
So the fund that I've just described, the most popular form is called a mortgage investment corp.
Yep, a MIC.
A MIC. And they take your $10,000, they invest that in a pool of mortgages. They take a fee for managing the fund, and they flow everything else out to you. So most of our investors, especially if they're in a registered account, will take that monthly dividend and reinvest it back into the fund.
Got it. So TFSA, RSP, and that can grow to either tax-free or,
Exactly.
Yeah, got it. Okay, that makes sense. And so you, back in the presentation, that great talk. You talked about the pros and cons of equities versus alternatives, and pretty much it seemed the only thing that equities have is that they're a little bit more liquid, which might not be a good thing. Talk about just the pros and cons really quickly beyond what seems like it could be a much higher return, right? Depending on the market. Let's talk more about the equities versus alternatives.
A great question, and it's something I love to talk about, and I have data to support all of this. But the alternative market, much higher risk-adjusted returns.
What does that mean?
It means for the amount of risk that you take, the volatility that you put up, you can make more money.
Yeah.
You can make more money.
Yeah.
I had one chart there and it showed over a 15-year period, the S&P returned 3% a year.
Right.
And one of our issuers, a very conservative apartment fund, averaged 13 and was lower risk, 140% less risky.
Right.
So that's what we mean by high risk adjusted returns. So first and foremost, we look for that. Second thing we look for is protection of principal. Losses can be absolutely devastating. We talked a bit today about if you look at sort of the major corrections over the last 100 years in the public markets, and you adjust that for inflation, it's over 20 years to recoup your losses in every major correction over the last 100 years. So we try and avoid losses at all costs. So we're very concerned about protection of principal, and we do that with security. Everything we do has some form of real asset behind it, so that in a bad situation, things don't work out the way we hope they would.
Sure.
We've got something there to salvage some value.
Right. Is there a stat around that, like, a 99.99% success rate, or like what is that kind of risk delta that you guys have? You can disclose it, or in general how these funds work?
Yeah, I mean it would really be investment dependent.
Yeah.
Because they all have their risk profile, and it really depends on what you're comparing it to.
Right.
But comparing it to public markets, alternative, better risk-adjusted returns, better protection of principal, better security, better cash flow, lower volatility.
Right. Just key for people that don't want to be on the roller coaster.
We call it sleep at night investments.
Yep. No, I love that. That really resonated. One thing that caught my attention there as well, I'm thinking of like a way to, sometimes if you can stack investments together, I think there's something interesting there. So there's an example of a Kelowna property, which is just what we talked about, a MIC. Right, it was returning how much again? It's the one where then people got first dibs at buying the apartment as an investment. So let's talk more about that. That seemed like a nice marriage of everything for real estate investors.
Yeah, so that was a pure real estate play. It was a real estate development. We started from working with the developer from land assembly right through construction. Yeah. So that project now is nearing completion. Our investors will be out in September with a 70% plus return on equity in 3 years. Another thing I love about this project is it's largely efficiency suites. Right. And most of these units sold for under $300,000. Wow. So it's
they're like Murphy bed. These are mainly
exactly right. Very livable space.
But students, by the way, because of the growing expansion of UBC Okanagan, they're going to pay through. The parents are going to pay super price per square foot or revenue per square foot is. I think that's what you mean by efficiency, I would presume.
Exactly right. Exactly right. And it's much needed affordable housing, and it's a chance for millennials to get their toe in the market and start building up equity over time.
Got it. It's not rental purpose. This was it's the next step is, as an investor, I can buy, you bought a suite. Yep. You're going to rent it. Then you've got the investment you put in to build the place, and now you've got a suite close to cash flowing, perhaps, depending on your down payment. Exactly. And that's just kind of how it goes. But the people got a foot in the door there. Was it a discount that you got? First access? What was the exclusive element?
So we structured it so that anyone who invested in the project, if they wanted to buy a unit,
yes, afterwards,
we had 50 out of 235 units set aside for our investors. So
that's a lot to give you guys.
So we got So we got first crack at the inventory, and this project sold out twice over in 72 hours. So that first look was was really worth something to our investors.
And they got the early heads up. Obviously, they financed it. Yeah. That's awesome. Maybe one last alternative we'll just talk about for fun is music royalties. Maybe let's finish off with that, and then we can talk about how people can get started.
Sure. We're just bringing on a new fund now. It's called ICM Crescendo. Right. And all of the aspects of alternatives that we look for, which is high risk adjusted returns, protection of principal, security. Believe it or not, music royalties tick all of those boxes. Yeah. So I guess they buy these catalogs of music from producers and artists, and they get the royalty stream for the life of the artist plus 70 years. Wow. And it's an asset it's almost like an apartment building. You're buying an existing cash producing asset. Yeah. You want to make sure your math is correct up front, you get it right. And they put this portfolio together and they just flow the royalties through to our investors.
What are the risks to that?
The risks are you get it wrong and it doesn't perform
Right.
everything's about a projection. So, and you've only got historical data to look at.
Sure.
So, there's some art and some science into
Sure.
how much you're going to pay for these catalogs.
Yeah. Super interesting. Maybe parting words for, again, the people that have just bought a place looking to rebuild wealth and do it a little bit more creatively. Any parting words for, how they can get in touch, or just in general summarizing our conversation?
Yeah. The name of the firm is Waverly Corporate Financial Services. It's waverlycf.com. Just reach out. We'll be happy to put you in touch with one of our reps. We have 51 representatives across Canada, and it's really about a big proponent on investor education and allowing people to learn about what we do and, pun intended, learn what their alternatives are.
Yeah, love it. And I would think watching this video, do I have to have minimum 25,000, 20,000, which is sometimes the case for mix, as we mentioned.
Yeah.
But with you guys, it's $1,000, and that's enough to get started in any of the asset classes, or just some specific ones?
It's investment specific.
Yeah.
So the lowest minimum we have is $1,000.
Got it.
And it's typically between 1 and 25 to get started. And
got it. Great way to start, Don. Thanks for your time, man.
My pleasure.
Good luck with things.